Recently, we have seen credit spreads widening across major developed markets, fueled by fears of AI bubbles, anxiety over private credits, and concerns over asset valuation.
On the back of the much talked about analogies on cockroaches and canaries, we think there are two overarching themes for investors to consider. First, fundamentals have remained largely stable, and alongside expectations of further rate cuts, risk assets should be supported in 2026. Second, we are currently in the mature phase of the economic cycle where more vulnerabilities are being observed. Potential credit risks warrant greater vigilance.
Billing. Many renowned industry figures have warned about cracks in the private credit markets. Should we be worried about private credits as we head into 2026?
Like the birth of high-yield bonds in the 1980s and the broadly syndicated loans of the 1990s, private credit represents the next phase in the evolution of credit intermediation. It plays an important role in the global capital markets as lending activities continue to migrate beyond the traditional banking system. However, it is essential to recognize that a significant portion of private credit activities supports smaller or mid-sized privately owned companies, firms that fuel economic dynamism but are inherently more exposed to growth pressures or sudden downturns. There are risks in the pockets of excesses that have built up in the system, including over-leveraged companies, weak governance, or complacent underwriting standards. Highly cyclical segments are also looking more vulnerable at this mature stage of the cycle. Hui Ling, how do we see the public credit markets in the year ahead?
For public credits, we expect global macro backdrop and rates trajectory to be key drivers of returns in 2026. Bond supply is also likely to pick up. With credit spreads at or close to historical tights, spreads could widen given limited headroom to absorb any macro volatility. We see greater return dispersion within credit markets and prefer to stay with high-quality issuers in this late credit cycle. In a more adverse scenario like a recession, no asset class is spared. But historically, investment-grade spread decompression is significantly less than high yield. As Fed eases, investment-grade and select better quality high-yield bonds should benefit from still stable fundamentals and lower funding costs. Billing. Within private credits, are there any subsegments we prefer? What's the story there?
Within private credit, staying higher up in the quality spectrum would give greater protection to investors. This would include senior secured lending and debt secured by real assets with high quality and long-term cash flows. Private equity sponsor-backed companies have also seen lower defaults in recent years. An elevated dry powder or unutilized capital amongst PE funds can support capital infusions by private equity sponsors during periods of stress. We would also prefer exposures with lower leverage, for example, at the fund level. Hui Ling, how about our views on duration? What are the preferences within developed and emerging markets?
We maintain neutral view in overall portfolio duration. In developed markets, we favor investment grade over high yield. Within emerging markets, we prefer Latin America due to its relatively attractive valuation and the potential election of more market-friendly leaders in certain countries holding elections in the near term. Billing, what is your key takeaway for our viewers on alternatives?
In 2026, alternatives will benefit from the tailwinds from monetary easing and resilient fundamentals, but face risk stemming from late-cycle credit behavior and potentially fragile public markets. Performance dispersion will be wide as managers continue to adjust to the realities in the new normal of higher funding costs. Hedge funds and both equity and debt exposures to structural growth themes like the infrastructure build-out in AI, energy transition, should form a part of investors' core anchor portfolio. Diversification, rigorous due diligence, and prudent leverage remain the cornerstones of resilient portfolios in 2026. Thank you for joining us. I am Bileng.
And I'm Hui Ling, and this is Bank of Singapore CIO Investment Institute.
For more information, please refer to Outlook 2026 publication.